How do you value this market today?
I think that just the way you said it is going to be a fool's journey to say, here's the stock market, and I'm going to time the movement into the market. I'm going to time the movement out of the market. Okay. You know what that means? Okay. You're going to guess what the next variant move is and what the next other thing is. A lot of things depend on a lot of other things, and everything readjusts. What has to happen, I think, is investors have to realize two things. First, that cash is not a safe investment, is not a safe place, because it will be taxed by inflation. There will not be an interest rate that will anywhere near compensate. And it seems good because it's not volatile, but you're paying a tax of a few percent a year on that. So A, stay out of that. And then B, know how to balance a portfolio, because the way portfolios work, it's almost like for some part, something happens, another thing happens. In other words, what you can see in the markets today is that, let's say when equities go down because growth expectations falter and there's a greater likelihood of easing, then you see the bond market go up. And when you see other markets, gold, you're seeing, watch the market action on every day, and you could see those relationships. Wealth is not destroyed as much as it is transferred. And if you know how to balance those investments, we do it in what we call an all-weather portfolio. But if you know how to balance those investments, that's the most important thing. Be in a safe, well-balanced portfolio. You can reduce your risk without reducing your return. And you will not market time this, because even if you were a great market timer, the things that are happening can change the world. So it changes what should be priced into the markets. Let's go back to sort of basics. For every individual, for every company, for every government, over a period of time, you have to earn more than you spend. And you have a balance sheet. There's an income statement and a balance sheet. When one becomes a reserve currency, others want to save in that. And that gives one the exorbitant privilege of being able to borrow in that and to create debt and money, because that's the thing. And it also gives us powers, like a lot of our sanctions come from the dollars being a reserve currency and so on. However, through history, it has always happened that currencies are devalued or destroyed. And in that cycle, when it becomes unattractive to own bonds or debt instruments in that currency, there's a supply-demand problem. Because a bond is a promise to receive currency. So what you are is, when you own a bond, you're long a lot of currency because that's what they promise to give you, and they have the printing press. And then there are shifts that happen. Who is accounting for world trade? Right now, China counts a larger share of world trade than the United States, for example. So what we are doing is we are in a fiat monetary system in which we are running very large deficits that we are monetizing, and that those deficits produce bonds that have to be sold. When I look at the supply and demand for those bonds, I know who the buyers are. You know, there are a limited number of really big buyers. And so I look at their portfolios and so on, calculate what that is. There's not going to be enough demand for those bonds. And there's going to be a need for more monetization of that debt. And so the answer is, yes, we're producing a change in the storehold of wealth. And you've seen it in the markets, because just think of it in a mechanistic sense. When there was that stimulation and the buying, what the Federal Reserve did in terms of buying that assets, there was not only the decline in real interest rates. We had, about 150 basis points decline in real rates and nominal rates down there. So the discount rate was lowered. You also had a lot of liquidity, which came in, and the world now has an enormous amount of liquidity bidding for a financial asset. If you increase the supply of bonds and you increase the amount of money, bonds are going to be worth less relative to other things. And you're seeing a shift in the storehold of wealth. And like the 1933 period, when Roosevelt did the same moves in 1933, you then saw assets rise because they're alternative storeholds of the wealth. That's what we saw in terms of the liquidity move that we've happened in market, also included in gold and so on. And so that's how it looks to me in terms of the comparison. We're now in a new era. We're in a new era. We are pressing the limits of that. And that money, at the end of the day, whoever's accepting that reserve currency's got to believe it.